So, how do we really know if a new trading strategy is a winner or just dumb luck? Have you ever wondered how we get solid answers to those kinds of tricky financial questions? Well, it turns out every valuable insight starts long before you even look at the data. It starts with a plan.
All right, let's get into it. The best way to think about research design is like an architect's blueprint for an investigation. I mean, you wouldn't start building a skyscraper without a plan, right? Same thing here. Before you collect a single data point, you need this detailed guide. It's what separates a rigorous professional analysis from just, well, a guess.
Okay, so this blueprint, what is it really? Let's break down the official definition, because this is absolutely critical for anyone making decisions in finance and business.
At its heart, a research design is just your master plan. It's your game plan for exactly how you're going to gather evidence, how you're going to measure what you find, and how you're going to piece it all together to get a credible answer. It's the framework that makes sure your entire project actually makes sense and stays focused. And this isn't just theory, it gets practical fast. Let's say you want to know if dividend announcements actually move stock prices. Your research design forces you to decide upfront. Are we looking at daily prices, minute by minute? Are we tracking the stock for a day, a week? Those choices determine everything. That plan is the whole ball.
All right, so how do we actually build one of these things? It really boils down to making a few key choices. These are the fundamental building blocks you have to put in place for any solid piece of research.
So you've got these 5 components. Now, we're going to zoom in on some of the most important ones. How much you, the researcher, get involved, where you conduct your study, what exactly you're measuring, and over what stretch of time. First up, we've got a classic dilemma. Do you want the perfect, controlled, sterile conditions of a lab, or do you want the messy, unpredictable, but, well, real reality of the outside world? It all comes down to how much you interfere. It's really a spectrum. You can just be a fly on the wall, simply observing what happens. Or you can step in and tweak one little thing to see its effect. Or you can go all out and build the entire environment from scratch to control everything. And this choice is huge because it determines if you can just find a connection or if you can actually prove cause and effect.
So let's start with minimal interference. Picture a bank administrator who's curious about the link between employee stress and manager support. They just send out a questionnaire. That's it. They don't change anything about the daily workflow, they're just observing. Now this can show a correlation. Maybe less stress is linked to more support. But, and this is key, it can't prove that one causes the other.
Okay, but what if you want to prove causation? Well, then you have to get your hands dirty. This is moderate interference. Now, the administrator might roll out a new manager support training program in one branch, but not in 2 others. By actively changing one variable out in the real world, they can start to build a much stronger case that, yes, better support causes lower stress. We call this a field experiment.
And then we have the extreme end, full control. To get as close to certainty as possible, you bring it all into a lab. You might have students manage a simulated stock portfolio during a market crash. You can then control precisely how much advice or support each one gets. This gives you incredibly strong proof of causation. But, and it's a big but, does this artificial lab setup really tell you what happens on a chaotic real-life trading floor?
So this gets us to the absolute heart of the matter. It's a classic trade-off. Do you want your findings to apply to the real world, even if there's a lot of other noise you can't control? Or do you want what we call high internal validity, which is just a fancy way of saying you're super confident that your change, and only your change, caused the outcome? There's no right answer. It completely depends on what you're trying to find out. Okay, so once you've figured out your setting, the next piece of the puzzle is deciding who or what you're actually studying. Are we talking about individual investors, or maybe trading teams, or entire companies? This is what we call your unit of analysis.
And your focus here can be anything from the super small to the absolutely massive. You could be studying the risk tolerance of one investor, or the dynamic between a client and their advisor, or the performance of entire banks, or even the economic growth of whole countries. Your original research question is what tells you where to point your microscope or your telescope.
A really key idea here is aggregation. To understand something big, like a national market, you don't just look at one number. No, you collect data from thousands of individual companies, which are made up of data from their divisions, which comes from individual sales. You start with these tiny data points and you roll them up to see the big picture.
Here's a perfect real-world example.
If a huge company like Procter & Gamble wants to figure out which part of their business is making the most money, they're not going to track every single bar of soap. No way. They aggregate or roll up all that sales data to the division level. Soap, paper, beauty, and so on. In this case, the division is their unit of analysis.
All right, last big building block for our blueprint. And it's a simple but really powerful one. Are you taking a snapshot or are you shooting a movie? This is all about your time horizon.
A cross-sectional study? That's your snapshot. You collect all your data at one single point in time. It's fast, it's cheap. You might find that companies with a lot of debt are more profitable today, but you have no idea if the debt caused the profit or if it's a ticking time bomb. On the other hand, a longitudinal study? Now that's the movie. It's more expensive and takes way longer, but it's the only way to track change over time and really get at causation.
For example, if an economist wants to see the real impact of an interest rate hike on the housing market, they can't just look at 1 month's data. That tells them almost nothing. They need to track mortgage applications quarter after quarter after quarter. Only by collecting data at multiple points in time can they see the actual trend and figure out if the rate hike really did the trick.
Okay, so we've covered how much you interfere, what you're measuring, and for how long. Let's pull this all back together, because this is where you see why having this blueprint is so incredibly important for anyone making decisions with real stakes.
And here's the most important takeaway of all. There is no single best design, ever. The perfect research design is always a compromise, a balancing act. It's about picking the right tools from your toolbox to answer your specific question with the time and money you actually have. Once you understand that, you can spot a weak argument from a mile away and know what a truly solid conclusion looks like.
So, I'll leave you with this final thought. In a world of messy, incomplete information, which is more valuable? A perfect, 100% certain answer to a question that doesn't really matter, or a pretty good enough answer to a real complex problem? The best decision makers I know have mastered that trade-off. Something to think about.